Well, let's digest some of that market action today with our next guest, Dana Denoria, InvestNet PMC Co-Chief Investment Officer. Thank you for joining us today. So as Jared was saying there, a choppy trading day as we're sort of bracing for what the Fed will do. How much of this is already priced in at this point, and why are we still seeing this volatility, given that we believe we know it's going to be that 50 basis point hike?
Yeah, it's interesting that we are, because if you look at Fed fund futures, it's something like a 99% that we're going to have 50 basis points. So you would think that there wasn't a lot of consternation in the market about what that's going to be. But those are futures, right? They're not the whole story. There is certain pundits are out there saying, well, maybe it's 25, maybe it's 75. We had a bad GDP print that leads you to maybe think under. Just the data that comes to me across my desk, I think with the reports we're getting that the job market is still pretty overheated, you're more likely, if anything, to see a 75 than you are a 25. But I think you're quite right. 50 is there and should be priced in.
How do you think the markets would react if it is indeed 75?
Yeah, I think we're going to have volatility one way or the other. So I hesitate to say it would be, catastrophic. But I do think that it would continue to hurt and continue to kind of reinforce what we've been seeing in the market the last month or so, right? I think tech growth, obviously very, sensitive to rate hikes. I think the Fed would be making a statement, obviously, at 75 that we have to really crush demand because we're trying to balance, obviously, supply and demand here and not successfully doing so. So it wouldn't be good for the market for sure. And I do think 50 is more likely, but I think 75 is possible.
Dana, where are you seeing opportunity? Because when you look at some of the leaders here, I guess if you can say that, the best sector in April was consumer staples, and it was up just around 1%. So what are you doing? Where are you putting money to work right now?
It's funny you say staples. A report just crossed my desk about the fact that if you look on a per company basis, mentions about inflation, staples is top of the list, which suggests to you, unfortunately, that as we start to see margins coming in a little bit, the ability to pass on these price increases gets more difficult. Staples generally are able to, just the nature of it, but and shortages is also being kind of mentioned a lot in earnings for staples. So you might start to see some margin pressure there. High level, you want to be broadly diversified. This is kind of a table stakes thing. But I would say, think maybe in terms of small caps in a market like this, and not entirely, obviously, but some tilt there, particularly higher quality small caps. Over time, they tend to outperform inflation. They're able to pass on these price increases. Not the growthiest, least profitable. Those tend to underperform actually dramatically, but excise those and you've got a pretty good inflation hedge over time, and also not as sensitive to the globalization issues that we're having right now.
And as we look at some of these higher prices, I mean, we're seeing consumer confidence remains depressed, but we're seeing this divergence with the amount that consumers still want to spend. How do you rectify that, and how is that informing your decisions going forward?
Yeah, well, so consumer confidence, there's the present day and then there's expectations, and we're seeing that the expectations are poor, but people are still spending real time. I think there is this element of everybody's kind of been stuck because of COVID, not going out, not getting back into travel, and there's just going to be a demand for that now as we go forward. But this is partially why the Fed kind of is taking this very hawkish approach of we've really got to bring down inflation. There's some indicators of peak inflation hitting, but when you look at the labor market being what it is and the possibility of a wage price spiral, I think the Fed is absolutely correct that demand, even though consumer confidence is in fact bad and an expectations basis, demand has not been brought in relative to supply.
You talked about opportunities. What areas would you recommend staying away from at this juncture?
I never think that you should be out of a piece of the market. I think all these indicators that we talk about, it's really on a short-term basis difficult to say what's going to even valuate. You look at valuation multiples, and I would say to you, okay, my answer to your question is growth, right? It's still on a valuation perspective, you should move more towards value. But in the short run, that's a medium to long-term indicator. So if you're talking about, hey, how should I be positioned over the long haul, I would say a diversified investment with maybe a tilt towards lower price stocks stocks with lower duration where you're getting a payment quicker so that higher interest rates are affecting it less. But certainly I wouldn't say to be out of it entirely. That could burn you dramatically, right? If we have a big run up in tech.
All right, Dana D'Auria, InvestNet PMC Co-Chief Investment Officer. Thanks so much for joining us this afternoon.